In this video, guys, let's look at what is a stop loss order. If you're new to trading, check this out. Stay tuned. Hey traders, warm welcome to you. All right, so stop loss order is super important. If you're brand new to trading, I'll give you a quick guide now to what a stop loss order is, so you can use it in your trading, you can manage your risk. Effectively, what we're doing with a stop loss order is doing exactly what it says it is. We are stopping the loss from going any further. So when we're in a trade and the trade turns out not to work, because sometimes, guys, trades don't work, we're not expecting to win all the time. What we want to do is, when a trade doesn't work out as expected, is cap the loss so we're not left with an unlimited loss that can potentially go on and on and on. Now, some little nuances to stop loss that we'll address later in the video, but quickly and briefly and simply as possible, let's talk about how we would place a stop loss, what it actually means and what it does. So really, a good definition, I think, is a place where you'll exit the trade at a loss, usually where your thesis is wrong. Now, some slight caveats to that, but ultimately what we're doing is trying to place our stop loss at a point where we want to come out of the trade if our trade idea is wrong, our thesis is wrong. So if our thesis, for example, is that the market is going to go higher and it goes lower instead, put simply, our stop loss is at a point where we think we're wrong and it's not going to go any higher and actually goes lower. So we come out of the trade, we cap the loss, we crystallize the loss, we take the loss, we move on to the next trade, as opposed to holding and hoping and it goes lower and lower and lower and lower over months, over years, and you end up with a losing trade that you're just constantly losing on. So we want to come out, want to cut it, want to move on to the next trade. The point is, guys, we're looking to express a trade idea. Take a trade, if it works, great, hold it as long as possible. If it doesn't work, cut it quickly, move on, cutting those losers fast. A slight maybe caveat to that is if we're using a stop loss that we've moved the stop loss up after the trade has gone in our direction, but I want to keep it simple for this video. So imagine if we're long. Let's imagine we've gone long on this chart, whatever this chart may be. A good place perhaps to put our stop loss is going to be under that previous support level here. Just an example. So we put our stop loss here. Now, as we're long, we're buying something. To go long, we buy something. So to close that trade, we'd have to sell that. Just like if we were buying shares in this pen, this company that owns this pen, we have this company Stadler. We bought the company. When we want to come out of the trade, we have to sell the shares in the company. So our stop loss is going to be a sell stop loss order. So let's say we bought it here, whatever it was, $100 a share, goes up, great. Stop loss order is not going to get triggered. However, if we bought it and the price kind of comes back down and we're wrong in our idea that the market's going higher, the shares in this company who owns the pen, who makes these pens, going to go higher, doesn't, comes back, our stop loss order will place with our broker and it'll automatically be triggered. And let's say, for example, that's let's say it's at $90, for example. And if it could be a forex pair, it could be anything. As it comes back to $90, it's going to trigger that automatic order. The order is going to be fired into the market. It's going to take you out of the trade for that loss. This is the beauty of it. It means you don't have to be sitting in front of the screen. You can put your stop loss order in, and you know that as the price gets to that, you'll be out with the loss. And if you bought at 100, came at 90, you've lost $10 per share, whatever the market may be. So this allows active traders to manage risk without having to be at the desk all the time. You put your stop loss order in, you leave it. Now, there's some slight little quirks to how stop losses trigger, which we'll address in a moment, but let's look at the short side. So shorting is we are selling something with the expectation that it goes down. Let's use this kind of example again with this company who manufactures these pens. Let's say we perceive them to be overvalued. We want to go short on the company, or we basically want to bet on a down move on the chart effectively. Could be a currency pair as well, could be commodity, could be anything. We're shorting, and let's say, for example, we want to have a stop loss there. We think the market's going to go lower and lower and lower, but if it goes higher and breaks that kind of resistance level there, we're going to assume that our thesis is wrong. We want to come out of the trade, we want to take the loss and move on to the next trade. But our stop loss here would be a buy stop because we're short, and to initiate a short, we have to sell. So we're selling shares in this pen. And again, maybe if you kind of want to do a little bit more research on how shorting works fundamentally, I've got a video exclusively on that. But for now, we just assume we're taking a bet in the direction to the downside. We're a bear, we hope the market goes lower, we're going to profit from every kind of move it makes lower. If it doesn't do that, we come out, we do a stop loss. Imagine we had the same numbers here. Let's say we went short at 100, and let's say, or short at 100 here, for example, and let's say our stop loss was at 110. As the market comes back up, if we're wrong and the market kind of comes back up and goes through there, our buy order is going to be triggered at 110, and it's a buy which is going to cancel out our sell. That means our position is going to be zero. It crystallizes the loss that we had. Now obviously the market carries on going, carries on. That's great. What we might want to do then is move our stop loss low, which is kind of the slight little caveat I had to this. Not necessarily where the trade thesis is wrong, it might be to lock in gains. So if the market, if we kind of got rid of this, if the market kind of moved lower and lower and lower and lower, and imagine that x-axis wasn't there, we might move the stop loss down to lock in some gains. We might move it down to lock in some gains. So effectively, even though we're gaining on the trade, it's still called a stop loss because it's an automatic order that takes us out of the trade. Even though technically we went short there and it comes back to here, we'd actually be locking in a profit. What we're doing is we're kind of saying, okay, we're locking the profit. If the market should reverse, I still want to make some money on this trade. I don't want to let it go all the way back to my stop loss. So you can move your stop loss lower. That's the other thing as well, guys. You know, you can be adaptable with your stop loss. Put your trade in, always put a stop loss in, because if you're wrong, you want to get out, move on to the next. Don't want to dwell on one trade too long as active traders. Take the money, take the trade. If it's running, keep the trade going. Try to get as maximum amount out of it as possible. If it's not working, cut it, move on, fund the next deal. Keep doing that, keep doing that. You're getting into trouble if you're not using a stop, or if you're holding losers and you're hoping. So this is what we're trying to do with a stop loss. And if the trade's working, ratchet it down. We can move a stop down. You can have half of a stop loss for half the position at some point, half the stop loss for the position of the other. You can play around and become more advanced with it. But the kind of key thing, guys, is that it's a place where it automatically will exit you from the trade you're in. Now, one kind of very brief caveat to that, or very brief kind of change, if you like, or a tweak, or anomaly is probably the better word for it, is when the market gaps through your stop. So if you've got a stock, for example, let's say you've kind of bought this stock and it's going nicely, if it closes and the next day it opens up below your stop loss, you're going to get filled at that price as opposed to your stop loss. But these are kind of minor things for the majority of people who are actively trading. This is not a huge consideration, but something to be aware of and something to kind of look at when you're creating your trading plan and designing where your stop loss is going to be. So stop loss order, guys, great, useful tool. Every trader should use it. So you don't have to be stuck in front of the screen. You know that the market or your broker is going to take you out of position if it gets to a certain level to stop you losing any more money. Take care, guys. Keep your risk managed, whatever you're doing. See you next one. Bye-bye.